Hey guys, welcome back to the channel. Today, we are diving into the European Central Bank, ECB, and the Euro area's economic troubles. Even as inflation slows down, the Eurozone economy is teetering on the edge of a significant downturn, led by Germany's industrial collapse looming large like a dark cloud over the entire Eurozone economy. Despite some temporary easing of inflation, the numbers are far from an invitation to pop the champagne. The euro might be on shaky ground, and the ECB's so-called soft landing mantra seems more like an elephant dancing on a tightrope, and we all know how that ends. So, buckle up, because today we are peeling back the layers of this crisis to get to the real issue at hand. The growing disillusionment with ECB's monetary policy, the economic ruin in the Eurozone, and the leadership void driving Europe into a recession. Now, before we get carried away pointing fingers, yep, we're looking at you, Lagarde. Let's first break down what's actually going on here and why the flashy headlines you're seeing in financial media or curated ECB press releases are missing the forest for the trees. Our dear ECB, under Christine Lagarde's watch, continues to juggle a precarious situation. Eurostat recently reported that Eurozone inflation fell to 1.8% in September, marking the first time it dipped below the infamous 2% inflation mark since 2021. It sounds like good news, right? Hold the applause, because behind that deceiving number lies a much more troubling story, one the ECB isn't exactly eager to admit, because it's their fault. Let's get the facts straight. Energy prices have taken a nosedive, directly dragging down the headline inflation numbers. So sure, the flash rate is currently lower, but services inflation, what central bankers deeply care about as it reflects the domestic economy's underlying health, is still at 4%. Ouch. Germany, the economic heavyweight of Europe, saw wages surge recently, which means those stubborn service sector prices won't back down overnight. And let's address this little gem from Philip Lane, ECB's chief economist. Wage growth has been sticky but has started to ease. Once workers' pay makes up for past losses in purchasing power, inflation will start dropping. Really? We've seen wage growth barely make up for inflationary damage smothering worker purchasing power over the last few years. The euphemistically called catch-up has barely put a dent in the real wage erosion that's left households holding an empty bag. Translation: working class, sorry, your livings have been collapsing for years, but when you quiet down a little bit on wage demands, we might get this inflation thing under control. When the stars align. But here's the kicker. Why is inflation cooling? It's not because businesses have suddenly become magnanimous or because supply chains mystically became efficient. The truth is, this is being driven by weakening asterisk demand. And therein lies the danger. The economy is stalling hard. And what's worse, it's happening in a staggered, uneven manner. Lower energy costs were the one saving grace, and even that is a volatile, unpredictable wildcard. Prices could easily spike again heading into autumn 2024 if geopolitics or supply chain disruptions rear their ugly head again. Speaking of demand destruction, let's zero in on the nightmare brewing in Germany's powerhouse, the industrial sector. Germany's economy is basically the Eurozone's relentless engine. But instead of revving up, that engine is sputtering, coughing, and teetering on the verge of a breakdown. Here's what's really happening behind the scenes. For the past year, Germany's industrial production has been in freefall. And I'm not talking about a small bump in the road. This is a full-on nosedive. September's PMI report painted an even more dismal picture. Figures showed Germany's industrial output contracting for the 19th consecutive month. That's right, folks. Approaching 2 years of recessionary conditions in Europe's largest economy. What killed the industrial golden goose? Green transition mismanagement. Drastic shifts in energy policy have led to an energy cost crisis. German industry, which relies heavily on energy, has seen costs spike while energy sources become less reliable. It's great to talk about green energy, but bad policy coordination has made it a burden on many firms. Export malaise. Germany's manufacturing base heavily relies on export markets, particularly China, which is slowing down. The ongoing trade war environment and decoupling are taking a toll on Germany, but few are eager to admit it. Persistent inflation in producer prices. Even when consumer inflation calms down, the costs and pressures on producers often don't, dampening their willingness to invest and innovate. Producer prices have shown volatility, intensifying the crunch on margins. Let's be blunt. Germany is tanking, and everyone else within the Eurozone is feeling the fallout of this collapse. The domino effect is becoming hard to miss. Berlin just lowered its growth projections. In fact, it's barely projecting any growth at all, calling 2024 stagnation at best after shrinking in 2023. Lagarde might be keeping up a brave face, but when the real engine of the continent is falling apart, the entire Eurozone's foundation starts trembling whether she likes it or not. Sips coffee with an eyebrow raised. Let's shift to the star attraction of our discussion today. The ECB's much-anticipated policy shift. For months now, we've seen them cling too long to high interest rates despite growing signs that tight monetary policies are choking growth across Europe. You've got Morgan Stanley, Goldman Sachs, JP Morgan, and a host of others all betting that interest rate cuts are coming sooner than planned. People, including 91% of money market investors, are now betting that there will be a quarter-point rate cut by October 17th, just 2 weeks from now. A further cut in December equals that would lower the ECB deposit rate to 3%. So what does this signal to the average observer? Only a few months ago, the ECB had a hawkish stance. We must keep rates up to tame inflation and cool the economy. But now that the economic pigeonholes have shifted, with a lackluster economy forcing their hand, further cuts are seen as a final Hail Mary to avoid the looming recession. But let's break this down honestly for our audience. Does anyone really believe 0.5% in rate reduction by year-end will undo the vast damage that's been caused by almost a full year of restrictive policies? The ECB makes it sound like small, iterative cuts will magically restore balance. Sorry to break it to them, but Jerome Powell's Fed-style gradualism isn't going to cut it when Germany's the iceberg, and the entire Eurozone Titanic is on the verge of impact. This déjà vu, but instead of clumsily trying to stick the landing, we're seeing Lagarde and company dance around real solutions, hoping optics will buy them time. But reality bites back faster than propaganda heals, and the euro is hardly immune to the volatility that this confusion has sparked. Economic fragility is seeping into every part of the Eurozone issue. Eurostat's headline inflation figure isn't enough to pacify people when the real economy isn't moving forward. If the ECB thinks they'll be the savior when they finally move toward lower rates next year, they better think again because the real damage to structural economic growth is already well underway. Look, the message I want to leave you with today couldn't be clearer. The ECB is now facing two options. Fulfill market expectations and start cutting rates now to stop the rot, or cling to its current trajectory only to force Europe into the ground harder. Trouble is, neither scenario leads to the recovery they're promising. The slowdown isn't just cyclical, it's structural. This isn't only about near-term inflation corrections and cute rate manipulations. Consumer and investor disillusionment is at all-time highs, seen in Germany's contracting economy, France barely holding on, and Spain facing turmoil. The green shoots narrative pushed by central bankers is just that, a narrative. One that's rapidly crumbling because ECB's policies have shackled economic growth. So what's the real problem? Political cowardice, overconfidence in quick-fix policies, and, above all, the disconnect between ECB elites and the real economic suffering of European households. In the end, the soft landing they promised may amount to just a profound sense of betrayal and disappointment when the European economy crashes harder than anticipated, with stagflation and recession as the new normal for 2024 and beyond. Austere measures, rising debt burdens, and a fractured European project all loom large on the horizon. Let's switch from the purely economic outlook to the much larger elephant in the room. The unstable political landscape that is exacerbating tensions within the European Union itself. While we're here, let's not forget one key takeaway. Whenever the economy falters, the social and political undercurrents brew into something much more dangerous. We've already had our fair share of populist waves over the last decade. But this time around, the fault lines are deeper and more threatening because the stakes have never been greater. Citizens across the Eurozone are growing impatient and dissatisfaction with the Euro integration project. One that was once hailed as a monumental success is evolving into a public backlash as governments continually fail to address the issues of growth stagnation, high unemployment, and poor living standards. Many Eurosceptics will point to the ECB's policies being dictated largely by Germany or France's bureaucrats, with little input from peripheral economies like Italy, Greece, or Spain, whose structural weaknesses are being glossed over in Brussels. Case study: Italy's rising deficit and debt crisis. Remember when Greece nearly tore apart the European Union after its debt crisis in 2010? Well, guess who's next? Italy. The Italian economy's precarious balance on a debt-to-GDP ratio already exceeding 144% could be the final spark that ignites yet another frenzy across Europe. Rome, under Prime Minister Giorgia Meloni, has been scrambling to maintain its stance on fiscal responsibility given Italy's debt burdens. But Italian households have suffered enormous hits to their purchasing power in recent years. An economic slowdown, worsened by energy costs and sluggish industrial output, pushes Italy's fragile banking sector toward a junk-rated status. Already under the strain of high borrowing costs, the Italian government's ability to raise cheap capital has been virtually annihilated. Since the ECB's bond-buying programs, remember the pandemic-era quantitative easing mania, have wound down, Italy, along with other highly indebted economies, has become increasingly reliant on market borrowing at persistently higher rates. If interest rate conditions don't correct in time, a sovereign debt crisis could erupt, prompting bailouts, austerity measures, and economic upheaval. And trust me, we know how well austerity worked last time. Looking at you, Greece. If push comes to shove, would the ECB ever have the political will to move quickly enough? Odds are slim. While Lagarde might be laser-focused on grand monetary charts, European citizens are far more focused on their dwindling bank accounts, and politicians are more and more feeling the pressure to reject Brussels' highly technocratic decision-making apparatus. Let's not kid ourselves. Italy may decide to break rank if pressures build up, further driving Europe toward a disintegration crisis. Markets are already pricing in increased risk premiums for Italy's bonds, signaling they expect something dramatic could be on the horizon. And this brings us to the next big question. As Europe's economies falter, where is the political union headed? Could Italy, Spain, Greece, or even Hungary, in the far-reaching Eastern Bloc, renegotiate their terms of membership within the European Union? The cracks are visible and widening. Every time the ECB fails to curb economic deterioration while hanging on to outdated labels like price stability and monetary normalization. Don't forget, political instability always precedes economic chaos. And when voters become restless, politicians shift gears, often toward populist and nationalistic sentiments, which is where the real danger lies. As a direct consequence of ECB's economic ineptitude, European governments could soon be forced down the path of austerity policies, much like we saw after the 2008 financial crisis. We remember what happened back then. Brutal social spending cuts, layoffs, and mass protests that crippled large swaths of Europe, while only superficially addressing the fiscal crises. But now, people have even less tolerance for government-imposed recessionary measures, because honestly, folks are already stretched to their limit. Yes, Europe's political elites can pretend that this time they'll do it better. But how do you sell that narrative to regular Europeans who can't heat their homes or find secure job markets after nearly a decade of economic chaos? By now, we're entering territory where continued ECB rate hikes could force fiscal retrenchments at a time when economies are ill-prepared to handle them. Watch closely here, France. While Macron might be prancing around on the global stage, promoting his vision of a sustainable economy, the reality back home is dire. The French public, facing unemployment, stagnant wages, and a deteriorating welfare state, can only withstand so much before they demand answers. Strikes, protests, and disillusionment with the leadership are brewing. And guess who has to deal with the fallout? The rest of Europe, because if France falters alongside Germany, the entire build-out of the EU crumbles down like a house of cards. Macron's government has already been forced to unveil heavy public spending cuts, especially as debt levels are stretching beyond manageable proportions. Sounds familiar? We know how this story ends. Mass unrest and economic gridlock. France, the poster child of EU support, may soon be leading the charge away from European integration out of dire necessity. Let's cut to the chase. The days of 2.5% GDP growth for Europe are long gone, probably dead forever. We are entering a long-term scenario where growth could stagnate around 1%, or worse, thanks to structural problems induced by the ECB's endless monetary tightening and half-baked economic reforms. What does this mean for European citizens? It means that wages will barely grow, disposable incomes will stagnate, housing prices will stay through the roof, all while public finances continue to crumble under a sea of debt. This is a recipe for mass disenchantment, as many people are quickly realizing that central banks don't have all the answers, and markets aren't going to save an economy when the fiscal and monetary policies are out of sync with reality. This is particularly relevant for economies like Spain and Portugal, where post-pandemic tourism recoveries may have masked underlying structural deficits, but inflation is eating away at whatever incremental wage gains workers have made. Loans to businesses, especially small and medium enterprises, SMEs, the backbone of economies like Italy and Spain, are drying up. Lending conditions are tightening as banks, unsure of the ECB's whimsical directions, grow increasingly risk-averse. This slowdown in business investment is going to hammer job markets across the EU, particularly in the south, where unemployment could plausibly spike again. And as if Europe did not have enough internal struggles, external threats are still lurking. The weakening demand from China, another former industrial powerhouse that served as a major trading partner for Europe, is delivering lethal strike number 3 to Germany's tarnished export-oriented economy. Beijing's ongoing slowdown, coupled with broader deglobalization trends, directly challenges those Eurozone companies reliant on foreign markets. Already, sectors like automotive manufacturing, pharmaceuticals, and heavy machinery are feeling the pressure of declining overseas orders, and the pipeline does not look promising anytime in 2024. The ECB has systematically underestimated the long-term implications of Europe's decoupling from China, especially on Germany's industries. If China falters further, expect nothing short of an industrial collapse that will ripple through the entire Eurozone. The question now remains whether policymakers will act fast enough to search for new economic alliances, particularly with the Indo-Pacific or even the United States, to mitigate losses. Early signs suggest Europe may be too far behind the curve for this. Folks, it goes without saying. On the surface, Eurozone inflation dropping beneath the 2% mark might look like mission accomplished for bureaucrats sitting high up in their ivory towers at the ECB. But what happens when you start diving one layer deep? We find economic stagnation at the core, rising unemployment, and whispers of potential debt crises across Europe's fragile states. Yet, we hear nothing but lip service from Christine Lagarde, showering the people in hollow promises about a return to price stability. But how stable is it when prices fall not from healthy regulation, but from growing demand destruction? How happy are workers in Europe when wage growth amounts to little more than catching up to past pain? If that, moving forward, expect intense financial disillusionment not just among individual citizens but institutions as well. Investors are well wary of the cracks forming in Germany's economic foundation. Let's be frank, the soft landing hailed by Lagarde isn't even close to being secured. In fact, Europe is staring down a painful adjustment period of sustained weak economic productivity, regulatory myopia, and political unrest that risks sparking a much more profound crisis. This won't only affect economists, bankers, or finance professionals. The impacts will trickle down, hitting ordinary European savings, job prospects, and living standards for years to come. But will the ECB react fast enough? Do they even have the tools left to respond effectively? Based on their track record so far, I wouldn't bet your life savings on it, that's for sure. The ECB's box of tricks is nearly empty, and what little they have left, interest rate cuts and bond buying programs, feels like trying to steer a sinking ship with a broken rudder.